Welcome to Barchart series of educational webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of features and tools Barchart provides related to these concepts, and offer some trader's insight to help you make a more informed investment decision. Today's session, profit from momentum, bullish stock screeners, and risk-defined option strategies. Now, bullish momentum can be measured in a variety of ways over a variety of time frames, but the simplest of ways is through a moving average. If price of an equity is exhibiting bullish momentum, then there's the tendency would be for the price to stay above an upsloping moving average. When price remains above multiple moving averages of varying lengths, it only confirms a powerful momentum. Barchart's new stock recommendations and bullish moving averages pages identify those stocks that have signals a new bullish impetus or have already exhibited strong momentum. And a trader or investor could simply just apply a trend following system and use the same signal or moving averages that recognize momentum as risk management. For those traders who feel more comfortable with defined risk, need only to execute an option strategy designed to profit from bullish momentum while limiting their risk. Hello, everyone. My name is John Rowland, Barchart's senior market strategist, and we're going to focus on two of Barchart's popular bullish momentum identifying pages. And we're going to examine trend following systems, their signals, the principles and benefits of moving averages, and how to apply mechanics of moving averages to execute two risk-defined bullish option strategies. So stick around as we discuss how to profit from trend is our friend while limiting our risk to the bend at the end. Now, before we jump into that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Good afternoon there, John. How are you?
I'm doing well. How are you feeling today?
I'm doing okay here.
Hanging in there?
Okay. Yeah, I'm hanging in here.
All right, Jean, it's hard to believe how fast this year is going. Here we are into November, isn't it?
I know. I'm going to be looking for my Thanksgiving turkey stuff soon.
Exactly. All right, before we stick the turkey in the oven, are you ready to get started?
Yep, absolutely. Let's go.
Okay, cool. Just remember that today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or any other investment involves risk and best made based on the advice of a qualified financial professional, and under no circumstances shall we be liable for any loss or damages that you incur as a result of any trading or investment activity that you or anyone else engages in based on any information or material you receive through barchart.com and our services. Okay, so let's jump into the site here. And what I want to do is I want to first start off in the stock area here, stock, and I'm going to go to trading signals, new recommendations. And I'm going to click on that. And that's going to take me to this page. And so what you get with this page is you're looking at the market. We've scanned for stocks that are above $2. Their 20-day average volume is above 1,000. And we have a bar chart technical opinion and last month technical opinion. Now, if you're not familiar with Barchart's technical opinion, it's a compilation of 13 technical indicators and their common interpretation. And these are the list of those 13 indicators. Some are a variety of simple moving averages, and others are a combination of two moving average crossovers. Now, a bullish signal occurs when price crosses from below to above the moving average. In the case of moving average crossovers, it's when the fast or the short lower time frame moving average crosses from below to above the slower or higher longer time frame moving average. So in other words, what we're seeing here is a different variations of numerous different types of trend following systems and signals based on either price or a moving average crossover. So if I click on, let's say, for instance, let's do this. If I click on the 20-day moving average, today we have 710 stocks that are exhibiting that price has gotten over the 20-day moving average. And if I click on that, it gives me all of those different stocks. Now, actually, you know what? I want to do the 50-day because I think that's what I looked at before. Let's do the 50-day. Okay. Yeah, this helps a little bit better. So what I can do here is, first of all, on this page here, when we go to, I have the option to look at not only buy signals, but also sell signals, holds and sell signals. But we're concentrating on bullish momentum. And also, I can look at the signal as it based on an intraday, daily, weekly, or monthly. And it'll tell me how much the price has changed, the percentage price, what our bar chart opinion in, again, technical opinion in the short and medium term and long range. And if I open up a chart, then this is going to take me to flip charts, and then I will be able to kind of visualize what's going on. Now, what I wanted to do here is, first of all, remember we're looking at the 50-day moving average. But up here in the right-hand corner is templates. And if you click on that, now, for instance, I have set up my flip charts for today's session using the template of 20, 50, 100, and 200-day moving average. Now, if I click onto that, this is a template that is in my collection of templates. But if you go into bar chart templates, this is that template, the 20, 50, 100, and 200-day moving average. So you can make this your own. All you simply have to do is click on this, add it to your flip charts, and then save as that template. Now you would name it whatever you want, and then every time you wanted to use it, you would know up here in templates where to find it, the 20, 50, and 100-day moving average. So again, notice on here, we're looking at this chart, and the red is the 20, the blue is the 50, the purple is 100, and the black is the 200. So you can see today's price action is above the 50-day moving average, i.e. that new buy signal. So the other page that we're going to work with today is in our investing segment. Actually, you know what? Let me do this. I'm going to go back again. Got to get my head straight today, John. Get your game face back on. All right, let's go back in here and let's look at moving average crossover. So again, we have a short terms, we have intermediate or medium terms, and long terms. Now, one that I wanted to kind of do today is the 50 versus the 200-day. And sometimes you might have heard of the death cross. This is one of the 50 crosses from above below, but above that would be called the golden cross, and that is actually a very strong bullish signal. And you can see there's 7 stocks that did that as well today. And again, if I go to my flip charts and I look at, let's say, HT, you can see here's our 50-day moving average, and now our 50-day moving average at 35.05 is above our 200-day moving average, 35.01. Again, a bullish signal. So the other momentum page that we can look at, or one of the ones that we're going to discuss today, is our bullish moving average page. And if I open that up, what you get in this one is a little bit different. Is what we're going to do is we're going to scan for bullish momentum over the short, medium, and long term, and those moving average patterns. And these are all large cap stocks. And what we're going to find here is we're going to scan and we're going to look for stocks that whose 20-day moving average is greater than our 50-day moving average. Our 50-day moving average is greater than our 100-day moving average. Now, there are some additional filters, one being the trend seeker buy signal. Now, we have a webinar on trend seeker, and excuse me, the condensed kind of definition is this is a proprietary system that uses a combination of multiple technical analysis measurements to find candidates that are exhibiting a trend. And if you do the bullish signal, well, then again, that would be a bullish or uptrending market. Additionally, we want to see those stocks that are within 20% of their 52-week high and their 20-day average volume is greater than 25,000 shares per day. Now, on this page, this is going to help you find candidates that are not only exhibiting bullish tendencies, but a condition called stacking. And this is where we see multiple moving averages that are layered upon each other, with the shortest time frame on top of the longer time frames being on the bottom. Again, if I go to my flip charts and I'm looking at my 20, 50, 100, and 200 day, this is a great example of stacking, right? This stock has a lot of super strong momentum because each of the varying length time frames are stacked upon each other. Now, this template does give you a secondary pane, and this is a comparative relative strength to the S&P. So what it's telling us here is that is our candidate here outperforming the S&P. If it's upsloping, it's outperforming. If the yellow line is above the crimson line, that is relative to any particular day or time frame. But for our purposes, outperformance just means strong overall momentum. Okay. So let's go back to our slides for a moment. And, we just looked at these two pages that will either scan or help us visualize a trend following system. So trend following systems, they try to attempt to generate entry signals based on a direction of a newly established trend that can be dependably recognized as soon as possible. Now, time frame does matter. Short time frames will give us quicker signals, but the risk is we might get some false signals or a lot more false signals. Longer time frames are a lot more reliable signals, but they're slow to recognize trends. In other words, price might have already moved significantly and we might miss out on some potential gains. Now, crossovers, again, as either when price crosses over a moving average or a moving average crosses a moving average. And the reality of trend following systems is they often produce less than 50% win percentages and may incur many small losses until a trend is proven. However, if we add some additional filters like time delay or an additional crossover signal, that can improve our accuracy, but that is at the expense of profits. So, for example, I might get a crossover signal, but I'm going to wait until I see a new 4-week high, or I get a price crossover signal, but I'm going to wait for that following moving average crossover signal that supports that previous moving average. So some of the principles of moving averages, and I kind of just want to go quickly through this. First of all, it's one of the oldest tools that technicians use. Again, very advantageous in terms of identifying methods, um, identifying trends and profiting from trends. Now, moving averages are really just a smooth visual representation of price action, or you could even say it is a fluid trend line. And moving averages are effective in markets that have a tendency to trend, key here for us. And in upsloping moving averages, the underlying asset price has a tendency to stay above the moving average. This concept of tendency is important for us because this is going to help us with our risk management. And moving averages can be useful in risk management as they allow investors to recognize where there could be a change in trend. So for us, what I'm really saying here is if price falls below a certain moving average, then this might be that bend at the end. As far as benefits of moving averages, again, trend identification, again, a fluid trend line, support and resistance. Moving averages acts as proxies of trend lines and can tend, you'll see that markets tend to respect moving averages. Now, for us, we're going to look at moving averages from a support. But in cases where our stacking is inverted, in other words, our short-term moving averages are below our longer-term moving averages, when we do our option strategies, we can use these as targeting or a targeting application. Signal generation, again, when price crosses over a moving average or we have the moving average crossovers, this is a signal generating system. And then determining price extremes. One of the benefits of moving averages is that they are statistical means. And when price deviates from that mean, there is a propensity of something that's called a reversion to the mean. Now, this can present both a risk and a trading opportunity. Now, today's focus, we're going to just concentrate on forward momentum and not mean reversion. We'll save that for another day. I just want you to be aware of that it is a risk. And if you're interested, check out our webinar on Bollinger Bands. So considering factors for choosing moving averages. So identifying moving average time frame that fits your style as a trader. If you're a swing trader, you're probably going to use, shorter time frames or, dailies, weeklies. If you're an investing type trader, well, then you're probably going to be looking at moving averages over, let's say, a longer period of time, 50 days, 200 days, so to speak. Fast versus slow. So a fast moving average or signal could be used as a signal entry, and a slow moving average could be used for a risk recognition. And, how many signals am I going to get, or that performance that we're going to get from these particular signals? So typically a faster or lower time frame moving average is going to give you a higher number of signals, but you're probably going to see a lower performance. And that's why we want to use multiple time frames. We want to use a combination of our slow and our fast. So however, what we could do is we could use a faster moving average as a signal to help us identify a trend condition. But what we would do is we would only enter into a position after a slower time frame signal. Now, the example would be, let's say, a crossover of a faster time frame moving average to give us that green light to go long, but I'm waiting for that secondary layer, that time delay, for a signal confirmation. In other words, a longer time frame signal. And so we want a lot of signals, or we want signals to give us identified trends as soon as possible. And this is where we're going to talk about frequency and recognition. So, here I went back to my bullish moving averages, and again, our top candidate was our WGS. So if I can just click on this symbol here, and that will take me to the overall page for WGS. And on the left-hand side, left-hand navigation side, I want you to go to where it says trading strategies. Again, these are those 13 technical indicators, the signals that are on our bar chart technical opinion, but this is specific for WGS. And what we can do here is I can click on a particular moving average or crossover. And again, what are we looking at here? Well, we're looking at a hypothetical trade based on these signals. And it is based on a look back of 5 years. So it's back tested up to 5 years. So let's click on the 20-day moving average. And again, I can look at all trades, or I can just look at buy signals. Now, WGS was a bit of an outlier. If I go back to the technical indicators, you can see that, all these signals have performed very, very well. And that is because this stock has been in a very strong momentum movement. So this is more of an outlier. It's not something that you're going to typically see. I just want to kind of point that out. But I'm going to look at just buy signals. And again, one of the processes we're going to do when we're trying to define a trend following system, especially when we get down to a very specific symbol, what I might find is which one of these signals is going to give me a better result or performance, and also how many signals that I'm going to generate. So in this case, of the buy signals over the last 5 years, we've got 54 buy signals. The average time in the trade is only 12 days, and you can see what the total profit is. But I think what this does is it really kind of helps enlighten us on this idea of trend following systems, that there's a lot of little losses before we get a larger gain, a lot of little losses before we get a larger gain. And larger gains come from more time that we're in a trade. That's the benefit of a trend following system. If we use proper risk management, we'll stay in that trade for a longer period of time. So again, looking at a frequency, duration, and again, performance. So the following rule here would be, or way of choosing moving averages, think of something called the quarter rule. And the quarter rule basically says, if I'm going to use a fast versus a slow or a signaling system, I probably want to use a 1/4 rule. In other words, my time frame should be, my lower time frame should be about a quarter of my higher time frame. For instance, a 50-day moving average versus a 200-day moving average, a weekly high versus a monthly high, or in this case, a 5-day moving average to a 20-day moving average. So let's talk about risk management as we use these moving averages. So moving averages can be used for stop loss levels. It's very popular among traders. Now, moving averages can help us select a level for us to limit our potential losses. The caveat is that we never really want to put our moving average, our stop, on a moving average. We probably want to use some type of a filtering system, be it below that moving average. And percentage price movements or average true range or a change in volatility are a great way to filter our moving averages. So an example of that would be, for instance, let's say I had a price stock that deviated away from a moving average. Well, I might use a 3 times ATR, average true range, from a particular swing high. But if it falls below that 3 ATR and then closes below one of my moving averages, then this would signal to me that then maybe I need to do some kind of risk management. Another example might be, I at one of my moving averages, but I'm waiting to see if price closes below it. And so maybe I might say I'm not going to stop myself out unless it closes 2% below that particular moving average. Okay. So let's go back to our investing page. And well, let me leave that up. Let's go here. Let's go investing, bullish moving averages. And again, let's go to our flip charts. So again, we're back in WGS, and again, a great example of stacking. Now I'm going to just turn off the comparative strength, and let's walk through these signals. Let's walk about how we can enhance those signals and how we can manage the potential risk. So let's go back a little bit in time. And you can see here, price here is crossing over our red line, our 20-day moving average. And it gave us a buy signal right about here. Now, I could take that as a long position. But at this moment in time, if I look at, let's say, my 50-day moving average, my 100-day or my 200-day moving average, you can see that the buy signal at the lower time frame, the faster time frame, is not supported by a higher time frame. So what I might do at this point is I'm going to wait for that secondary confirmation. Now that secondary confirmation could be a variety of different signals. The one could be we could wait for price to capture the 50-day moving average, or in this case, probably was a better signal would be when the 20-day moving average crosses over the 50-day moving average. But again, notice what is happening with price. Price has moved higher. Again, potential gains that we would have had, we were going to give up for greater confirmation. Now, I could be very conservative and I would say, hey, yes, this is a positive condition that I want to see, but I'm very conservative. I want to wait for an upsloping 50-day moving average, or I'm going to delay my entry based on the 50 crossing the 100-day or the 200-day. So again, price has probably already moved a longer distance, and again, giving up some potential profits. But let's look at another crossover here. Again, you can see here we have our 20-day moving average, and you can see we kind of bounce back and forth. Again, trend following systems, when you're in a sideways trends, are going to give you a lot of false signals, and the market is going to put you in and out on just that one signal. But again, let's look here. We can see this one green candle here closed above the 20-day moving average, and that would be a buy signal. Now, what's different from this scenario than what we saw here is that in this case, our 50-day, our 200-day, and our 100-day are in support. That's stacking in support of this buy signal. So I could take this trade as is and then risk that supportive moving average. In this case, I could use the 50-day moving average as my risk on my entry of the 200-day. But again, if I'm a little bit more conservative, again, I might delay my entry based on time or price movement. But since I have a supportive longer term moving average, maybe what I would do is wait for us to make a new weekly high or a new monthly high based on previous price action. And again, you could see if I waited for that, that wouldn't have put me into the market until about here. Again, losing some of that potential profit. Now, as long as I respect this moving average, and this is what's the benefit of trend following systems, is as long as price has the tendency to stay above our moving averages, then I'm just going to stay in that trade. And you can see that that happened on this particular stock for a long period of time. Now, what we can also do, as we said, we could look at other potential crossover signals besides the ones that Barchart uses. I could define one by myself. So here I'm going to go up into indicators, and I'm going to click on that, and I'm going to scroll down. Now notice it says I'm in overlay studies, and I'll show you what that means in a second. I'm going to scroll this down, and I'm going to go to where it says moving average crossover. And so here you could create your own moving average signal, crossover signal, based on your time frame or your style of trader or the risk that you're willing to take. Now, again, this is an overlay indicator, which means that you will see it on your main page. So what I usually do is I change this to a new pane, because then what I have is, I'm going to have all these lines here, and they're all crossing over, and it gets, it gets kind of messy. It looks like a bowl of spaghetti. So I'm going to look at this from a new pane, but I can change this based on, high, low close, or a high, low close, or an average of that, or I can change it by a simple moving average or a weighted moving average. And then I'm going to add that on a new pane. So again, let's go back in time. So I'm looking at a 5-day moving average versus a 21-day moving average. To me, that is a sign of short-term bullish momentum. So I'm waiting for that buy signal, but I'm still going to wait for the confirmational. Now, in this case, the buy signal came after price got above the 20-day moving average. So what would be our next confirmational signal? Or our next confirmational signal would either be price above the 50, or in this case, the 20 crossing the 50. Again, I think that would be a much better confirmational signal. And again, as long as my 20 stays above my 50, then I would stay in that trade. And you can see that that happened for a long period of time. Again, remember that outlier of this potential candidate. But we do see here that my 20 and 5-day signal gave me a sell signal. Excuse me, 21 and 5 gave me a sell signal. That is telling me that there is a change in trend in the short term. So that might tell me that it's time to use some type of risk management. And you can see here that, price did fall below our 50-day moving average, an area where I would probably stop myself out or use some type of risk management. Now, in this case, right, we did get a deep penetration, but we closed right back on the moving average. Again, an importance for us to understand that when we're using moving averages, we probably want to wait to see a closing, not necessarily an intraday signal. But you can see that we did get another sell signal here, and we did get some closes below the 50-day moving average. So that would have stopped us out. But again, the condition changed, short-term positive momentum can change. That would give me that buy green light, but now I need a confirmatory signal. But in this case, we have both our 20 and 50-day that are in a supportive of this. So we could have taken this trade as is, or maybe I wait for us to make, a new weekly high or monthly high, and that would have probably put us in on this candle. And again, manage my risk from either the 20-day moving average or the 50-day moving average, or if I get another sell signal in that short-term momentum crossover signal that I've designed for my own personal style of trader. Okay. All right. So hopefully I've convinced you this idea of trend following systems and how you can use the multiple crossovers to help you define signals and also to enhance those potential signals. So you might say something to me like, I like the concept of trend following systems, but I'm risk adverse. And, I want to be able to define my risk. And, options offer a great alternative to trend following systems. So we're going to look at two very particular option strategies. And again, we're just going to be at the elementary, intermediate type level. We do have multiple webinars that go into a lot more detail how to trade these systems. I just want to kind of show you how you can overlap our trend following signals with our option strategies. Now, today is going to be a difficult day for a couple of the examples because we have a huge blow off today. So we'll see that in the charts. But again, the concept here is employing one of these option strategies based on a signal that I've already created or I'm waiting for. So the first one is the bull call debit spread. And this is a directional vertical spread where a trader simultaneously purchases a call of a lower strike and sells a call of a higher strike with the same expiration. Now, the lower strike call is going to cost more than the higher. And so a debit is incurred. And then this debit is our defined risk. The short call caps the potential profit, which is the spread differential minus the debit paid. The other options strategy we're going to look at is called a bull put credit spread. In this case, what we're going to do is we're going to sell a put that is closer to current price and then buy a put that's farther or below our first leg. And the strategy here generates a credit, and it aims to profit from two pieces of information here: time decay and bullish momentum. And as long as the stock price stays above the first put, the leg one we sold, then that strategy will be successful. But we are limited to the credit or the premium that received. And the risk is, again, that difference between the spread and the credit that we receive. So strike a selection. How do I go about choosing the strikes of these two different strategies? So if I'm aggressive and I'm using strike selection, I'm probably going to choose strikes that are closer to at the money or near the money. Remember, we're having a greater confidence because of our bullish momentum, because of the signals that we achieve. But for put selection, what we could do is we could use those moving averages or those crossovers as strike levels. And what I want to do is I want to coordinate those moving averages with our time to expiration. So what do I mean by that? So in other words, if I have 20 days to expiration, then maybe I might use a 20-day moving average. But we can also look at another technical tool, and I'm going to show you that in a moment. But for call selections, again, where you want price to move favorably for us, we can assume that the stock will appreciate by 2 times the at the money time premium. Again, we have a nice tool that helps you do this or helps you manage that. So here's some generalities when we talk about these two types of strategies. First of all, the greater the volatility, the more significant the time premium. In other words, the greater the volatility, the more expensive these options are going to become. So, in a general sense, what we want to do is when we have high implied volatility, we're probably more likely to sell options. In other words, we're going to employ the put credit strategy. In low volatility, then our options are cheap. So we're probably going to employ the call selection option strategy because we're getting more value or bang for our buck, so to speak. And then when I pick my strike selections, depending on how far they are out of the money, in the money, or at the money, it's going to determine a probability, either a probability that we're going to be successful in the money or a probability that that the strike will stay out of the money. And so I want you to understand that the higher the probability, the lower the profits you're going to get. The higher the profits you want, you have to lower your probability. Okay? All right. So let's go back to our bullish moving average, right? And so the first thing we got to do is we're going to come back in here and we're going to screen. And we're going to just do some simple screening here. So the first screen I'm going to do is I'm going to just type in options. And then we can't trade options unless this market has options. So again, you can look at just all options, or you can look at only ones that have weekly options. Again, depending on the type of options trader you are. Now, under the options overview, I also want to come down here. It says total volume. And I want to look at, make sure that this particular stock has a total volume. So I'm going to just say over the last 5 days, right? And consistently, you should see a good volume level over a weekly period, regardless of that stock. Now, you could set a limit, right? You could say 1,000 shares or 5,000 or 10,000 or whatever, or you could just leave it blank and then do this. So let's see what the result is. Again, now we've lowered our risk, our number down to 159, still a lot, but here I'm going to go over here where it says total volume and I'm going to sort by that. And so you can see here we have a lot of candidates that have high volumes, and that's important for us, especially when we do spreads, because this is going to mean there's going to be tighter bid ask, and it's going to be a lot easier for us to do these type spread trades. But if I'm looking at, let's say, some of these candidates down here, these might be great candidates in terms of momentum or stacking, but again, not a lot of volume. So it's going to be difficult for us to get some really good value in some of our trades. So again, let's kind of look at this. And I was kind of looking at this morning. Now, MicroStrategy is kind of a proxy for Bitcoin. Maybe we'll look at that in a second. But let's see, I saw United Airlines. So let's do this. Let's go to our flip chart first, and let's kind of look at this as a potential candidate. And again, what's making today very difficult for a lot of the option strategies we're going to look at today is, we're going to see a lot of charts that are looking like this. So there's a big gap up. So, but again, remember, we're going to define a strategy based on either volatility and or the signal that we're going to get. So, again, here we see United Airlines has gapped up and we're not getting any new trading signal. But again, just work with me on this one. So first of all, where's our 20-day moving average? Well, it looks like it's around 73, 79. Let's just make it 74. And certainly we can see we've just recently gapped above $80. So let's say, for argument's sake, we got a buy signal on one of our moving averages or one of our crossovers that happened today based on price gapping above $80. So what I can do is I can come back into United Airlines here, and this stock has, again, look at this. This stock has a lot of nice bullish momentum, right? So maybe what I'll do is I'm going to do the bull put. Now, where do I find that? Well, that's under the vertical spread here. And I'm going to look at the bull put. Now, remember, part of the bull put strategy is time decay. So the less time I give, the more probability that these strikes are going to finish out of the money. But the less time I give also lowers my potential profit. So let's kind of find a happy medium here. So 23 days out, which would be reflective of our 20-day moving average. And we said that our signal was going to be the $80, and our risk, we said, would be that 74. So I can come back in here and let's sort these strikes here. And so here we got an 80, 75, right? I'm going to sell the $80 put, and I'm going to buy the $75 put. Now, I'm going to be able to collect 69 cents or $69 for each one option that I do. And my risk here would be $4.31. Again, watching the put strategy, bull put strategy webinar, we're going to talk about a lot of details about this particular strategy. But just as a general rule, we kind of want to get closer to, let's say, 1 to 3 or 1 to 2 if we can, in terms of the reward or credit we're going to receive versus the strike differential. Now, we're probably not going to be able to achieve that because we're at a shorter time frame length. But again, you can just see here that we're getting 1 unit of reward for about 6.25 units of risk. Now, what could I do? I could modify this. Maybe I could go for a lower strike and bring that spread in closer together. So let's look at it from the other aspect, and that would be from the long. All right, so we've got a buy signal. Let's say, again, using that 74, potentially using that $74 as a risk. But now I'm going to be a little more aggressive. I've got that buy signal. Let's say, maybe that buy signal here is around $82.50. So I'm going to come back into United Airlines here and again, go to my vertical spreads and I'm going to look at the bull call, right? And, I'm going to do my strike selection that's going to be close to current price. Somewhere, like we said, maybe around $82.50. But where do I choose my higher strike, right? What is that target for me? Or how far do I anticipate that stock is going to move over a certain period of time? So we said that one of the rules we could use is 2 times at the money. Now, if I go to options prices, and I'm looking here first at these weeklies that are 23 days out, and I look at where current price is, and I can see these different strikes, and one of them is in the money, one of them is out of the money, and how much is the time premium? Well, time premium is just how much it's not in the money, or in this case, in the money minus. But we do have a tool which is called the expected move. And the expected move here is going to give you the 85% of the value of the at the money straddle. In other words, we do the calculation for you, it's about 85%. The other thing when I do call spreads, because I'm buying time, I don't want time decay like we saw in the credit spreads. So I want a lot of time. I want this market to have time to go in my favor. So if I go to like the January 17 monthlies, which is 72 days, I'm not going to really need to worry about time decay for about another month or so. But we can see our applied movement here, or applied move, would be expected move would be around $10.97, or let's round that off at $11. And you can see that upside from current price would be around $97. So again, I could go back to my vertical spreads, bull call, pick the January 17s, and again, I'm going to sort these. And again, I'm going to be a little bit more aggressive. And here we got the 82.50 call versus the 95, which would be inside of our expected move. And in this case, it looks like it's going to cost me about $7 with a potential risk, the defined risk, excuse me, a profit of $7 with a defined risk or cost of $5.55. Again, a low risk to reward ratio for this type of trade. I probably want to get closer to 2 to 1 or greater. But again, I'm just showing you how you can use this tool to select and how to do some comparison on this. Again, we might change our time frame longer or shorter, and we might get a much better risk to reward. Again, probably what might drive this trade is our implied volatility, and also how does that implied volatility rank or where it is in the percentile. So we're kind of neutral here. So probably both strategies would work for United Airlines. All right, Gene, so let me do this for a second before we move on. I want to answer a couple of these questions. I see you've been answering a lot of them for me as well, so thank you very much. And then we'll see if we can finish this up.
Yeah, while John is reviewing the questions, just want to remind everybody, as I usually do, that Barchart has different levels of membership. And I know I answered one question about getting alerts about these crossover signals. That's a premier feature. So if you're interested in trying out some of the things that are available with our Plus and Premier subscriptions, we do offer a free 30-day trial. So I encourage you to contact support. One other thing I'm going to say is some of you have sent in some very, very detailed questions. And if John does not get to those today, you can always email support@barchart.com. They can forward those on or possibly even answer them directly themselves. So if we don't get to your question, go ahead and email support.
All right, let's start off with Wayne. Wayne's one of our regulars. Hey, Wayne, how's it going? So can you comment on standard moving averages versus exponential? So again, it's a preference. Just basically the rule here is that if I'm looking at a 20-day standard or a simple moving average versus an exponential, just understand that the exponential is more sensitive to current price, and that means it's just going to be closer to your current price. So what does that mean for us in terms of risk? Well, it's more sensitive. It means that price action is more likely to get closer to that than, let's say, a simple moving average. So a simple moving average, in theory, would have more risk in terms of a price value, but a simple moving average an exponential moving average would give you a more sensitive, but there could be a risk that it gives you a false signal, right? Because it's too close to current price. So again, I kind of like to use EMAs for entries, and then use more of those simple ones as that kind of that risk management. In other words, I'm going to be a little more static, a little slow to react to that. Okay. Question here is, when do you enter a trade when the moving averages stack up or correctly right away, or on a pullback? Again, it depends on the particular trader or your trading style. But again, what we said was, what we could have is a signal indicator. In this case, one of the signal indicators that I use is that EMA, again, what Wayne just asked, signal, right? Here we got that. That is telling me there is a bullish momentum condition, but I'm waiting for that confirmation. Now, that confirmation could be whatever next signal, depending on what signals I look at. So you can see that that occurred here, right? So what would probably be my next signal? Well, it would either be price above the 50-day moving average, or I'm being very, very patient and waiting for the 20-day to move over the 50. Now, the question is, what will we do if we're in a stacking situation, right? Now, again, uh, this is where, if I come into here, there's no signals for me. There's no signals for me to come in, right? The signals have already occurred. So you would have to use some other type of technical analysis. One very common one that a lot of investment type traders use is, a new monthly high or a new 4-week high is a really good bullish indicator. But let's see if we could go to MicroStrategy real quick. And again, here we do have kind of a stacking going on, right? But what we'll be waiting for, right? We've gotten that buy signal, we've gotten the crossover, but maybe we're waiting for that new, that new weekly high or that new, all-time high to give us permission to jump into an already moving or momentum market. Okay. Another thing I want to kind of just do real quick here before we finish up is when we talked about sorting is, let's go back to our bullish moving averages, okay? So again, this is excuse me, not our bullish moving averages. I want to go into my top recommendations here, okay? So remember, the bullish moving averages are already stacked, okay? So the question is, how do you jump in after the stack? But here, what we could do is, let's say, maybe I have this 20-day moving average, right? Or excuse me, this 50-day moving average, or I'm using the golden cross, right? So what I could do here is go to these 500 stocks. Again, I can sort by options and all kind of that, but I can also screen here by opinion indicators. And let's say, in this case, what I want to see is, all right, I'm above my 50-day moving average, but am I signaling a new signal? Let's say the 20 over the 50. Now, I don't know if this is going to give me something today, but is it giving me a new 20 over the 50-day signal? Or could I say, I want to just make sure I'm in that stacking condition? Well, let's just see what it says. Again, I want to do buys, and boom, there you go. So now we went from 500 or whatever that number was, 400. Now you have 29 candidates that are in a bullish 50-day moving average, but have given you a new 20-day crossing, right? That time delay entry. So this is a really good way to give you that confirmational entry after you've gotten the proper conditions for that particular trade. Okay, so I hope you guys enjoyed today's session on moving averages. And again, just kind of a takeaway here is there's no right or wrong. Understand that smaller time frames give you a lot of false signals. So that's why you probably want some kind of complementary or confirmational signal. Again, higher time frames signals are a lot more reliable, but again, you're going to give away a lot of price movement to gain that confirmational or that confidence in your trading. And then remember, when you're choosing your option strategies, if you have high implied volatility, probably look at credit spreads. And if you have low implied volatility, look at those potential debit spreads, those bull call spreads. Okay, Gene, thanks for answering a lot of questions. I appreciate your help. Folks, we're going to be taking a couple of weeks off. We'll be back after Thanksgiving. Until then, the best of health, manage your risk, and the good of all trading.